The car broke down on a Tuesday. The repair was $900. You had $212 in your account and 11 days until payday. You did not call a mechanic first. You called 3 people to see if anyone could lend you money before you called a mechanic. That is what zero savings feels like. It is not a financial condition. It is a social one. You spend the crisis finding out who will pick up. Here is what changes at every level of savings, and here is the number that determines which version of that Tuesday you live. You have nothing saved. Your checking account runs between $0 and $400 depending on where you are in the pay cycle. Every unexpected expense is a negotiation. The transmission, the medical bill, the flight for the funeral. Each one requires you to sequence a solution in real time. Which bill can wait? Who owes you? What can you sell? At this level, your cost of being alive is higher than it is for everyone else. You pay late fees because the timing was wrong, not because the money wasn't coming. You pay the higher insurance premium because you cannot cover the larger deductible. You pay short-term borrowing costs, overdraft fees, cash advance fees, the interest on the credit card you use to cover the gap that someone with $1,000 saved never pays. Poverty is expensive. Not metaphorically, arithmetically. The average overdraft fee is $35. If you overdraft twice a month, that is $840 a year. That is your emergency fund, spent on the absence of one. At $1,000 saved, one fee stops. $1,000. You have reached the first threshold that changes your behavior before it changes your math. The car breaks down. You call the mechanic first. You do not sequence. You do not negotiate. You pay, and you move on. The $900 repair costs you $900 instead of $900, plus 2 overdraft fees, plus the interest on the card you would have used, plus the late fee on the bill you deferred to cover it. $1,000 does not make you financially stable. It makes you financially capable of absorbing one thing: one medical copay, one car repair, one missed shift. Outside of that single event, your exposure is identical to 0. But inside it, the difference is the Tuesday you don't remember versus the Tuesday you tell people about for years. Your savings account is earning 0.5% interest at a traditional bank. $1,000 generates $5 a year. That number is not the point yet. The point is that the balance exists. At $3,000, the second category of expense disappears. $3,000. You now cover the standard insurance deductible on your car and your health plan without restructuring your life. The most common financial emergencies, a car repair, an ER visit, a broken appliance, fall within this range. When they happen, you cover them. You do not remember them 6 months later. At this savings level, you qualify for better financial products. A landlord who requires proof of reserves will rent to you. A lender offering a personal line of credit at 12% will approve you, where before, the only offer was 24% on a credit card. The $3,000 balance is not just a buffer. It is a credential. You are not investing yet. Every dollar in savings is sitting in an account earning $5 per thousand per year. You know this is inefficient. You leave it there anyway because the alternative, moving it into an investment account and watching it fluctuate, feels like removing the only floor in the room. At $10,000, the floor becomes structural, and the cost of leaving money in savings becomes real. $10,000. This is the number most financial planners call a fully funded emergency fund for a single person with average fixed costs. 3 to 6 months of essential expenses. At this balance, the behavioral shift is not what you can absorb. It is how long you can survive without income. You lose the job. You do not panic on day 1. You have a horizon. $10,000 at $2,000 a month of essential expenses is 5 months. 5 months to find something without taking the first offer because the rent is due. The savings account is not generating a return, it is generating optionality. The ability to say no is worth more than the interest differential. At this level, you open a high-yield savings account earning 4.5%. $10,000 now generates $450 a year passively. You notice this. It is the first time money has made money for you in a way you can feel. At $25,000, the composition of your balance changes. $25,000. You have crossed the threshold where keeping all of your savings in cash becomes a decision with a measurable cost. Inflation at 3% erodes $750 of purchasing power from your $25,000 balance every year. The high-yield account covers most of it. The gap is small, but the gap exists, and now you can see it. You open a brokerage account. You move $15,000 into a low-cost index fund. $10,000 stays liquid. For the first time, you have two pools of money doing two different jobs. The liquid pool covers emergencies. The invested pool is on a different clock. It does not care about the Tuesday the car broke down because you are not allowed to need it on a Tuesday. At 7% average annual return, $15,000 becomes $29,500 in 10 years. The market earned $14,500 while you were at work. You did not contribute a dollar of it after the first deposit. At $100,000, the machine starts running faster than you can. $100,000. This is the number where compounding stops being a concept and starts being a line item. At 7% annual return, $100,000 generates $7,000 a year. That is $583 a month appearing in your account without a corresponding hour worked. You are still employed. You still need your salary, but the ratio has shifted. Your invested capital is now earning the equivalent of a part-time job. Every year you leave it untouched, that part-time job gets a raise. At year 5, the same $100,000 with no new contributions has grown to $140,000 and is generating $9,800 a year. The critical variable at this level is not the return rate, it is the cost base. If your monthly fixed costs are $3,000 and your invested capital is generating $583 a month, the capital is covering 19% of your cost of living. If your fixed costs are $8,000, it is covering 7%, the same balance, the same return, a completely different position. At $500,000, your capital generates $35,000 a year. You have not worked a single hour for it. $500,000 invested at 7% generates $35,000 a year. The median household income in the United States is $74,000. Your capital is now earning 47% of that figure while you sleep. If you have kept your fixed cost base below $3,000 a month, your capital is covering nearly all of your essential expenses. At this savings level, work becomes a different transaction. You are not working to survive. You are working to accelerate, or because the work matters, or because you choose to. The absence of that compulsion is worth more than the $35,000 a year the capital is generating. Your balance is growing by $35,000 a year from returns alone, before any new contributions. The machine is now running faster than a median salary generates in take-home. At $1 million, you have crossed the final threshold. $1 million. At 7% annual return, this generates $70,000 a year. After capital gains tax, depending on your bracket and the structure of the account, you keep between $59,000 and $63,000. That is the median American household income generated entirely by capital that is no longer shrinking. You are not rich in the way the word usually means. You cannot buy anything you want. You can buy time, permanently. The $1 million threshold is the point at which the machine generates enough to run itself and cover a standard life without drawing down the principal. Every year you leave it, it grows. Every year it grows, the number it generates increases. The car will break down again. The repair will cost $1,200. You will not remember it happened. 3 things you can do today. Open a high-yield savings account if your emergency fund is sitting in a traditional bank account earning 0.5%. The difference on $10,000 is $400 a year. The account takes 11 minutes to open. Calculate your savings rate as a percentage of take-home, not gross income. Divide what you saved last month by what actually landed in your account. If the number is below 10%, identify the single largest discretionary line item and cut it in half before the next pay cycle. Set up an automatic transfer on payday, not at the end of the month. The money that moves before you see it does not get spent. Start at $50 if that is what the math allows. The habit is the variable. The amount scales. Somewhere tonight, someone's car is broken down. They are not calling the mechanic yet. They are running the sequence in their head. Who owes them? What can wait? Who will pick up? The distance between that Tuesday and a different one is not a salary. It is a balance.